Hey everyone, it's David Barnett from investlocalbook.com. Standing in front of my brand new full-size whiteboard that I have here at the new house. One of the first sort of components of the Opportunity Lab that I've spoken about in a couple of my videos. As you know, I recently asked people if they were sitting down for a cup of coffee with me and could ask just one question, what would it be? And I've got to tell you, I was totally blown away. The kinds of questions that I've gotten, I would never in a million years have dreamt them up myself. So thank you for everyone who has submitted one. And don't be afraid if you didn't to send one in. That's fine. I'm going to take one of the wackier ones and answer it for us here today. This one comes to us from Bill. And Bill asks, how do I find and convince investors to invest between $1.5 and $2 million on a large rental complex, such as 150 units, in Florida, with up to $1 million in renos, and have me manage it? Like, it's crazy, right? Anyway, Bill, I've been spending the last couple of days thinking about this, so I'm going to take a stab at it. And just so that we're absolutely clear, I have never done this. But I have pooled investors together before for a mini storage project. So I'm going to draw a lot on those experiences that I had over there and try to figure out a way that we could do this deal for you. So the very first thing we have to figure out is you're saying that you want to raise between $1.5 and $2 million for a large rental complex. I don't know if that means it's the total purchase price or not, but we're just going to assume that this project, including renovations, is going to be a $5 million deal. So $5 million is our total. The very first thing we have to do is figure out what kind of leverage are we going to be able to apply here. So leverage is borrowing. Borrowed money is cheaper money usually than equity because investors want a big return on their money. People don't want to take a risk to get like 3% back, but a bank, if they have a secured loan against the building, they might be very happy with 3%, for example. So if you're going to put a whole bunch of investors together, there probably aren't going to be any particular investors that are going to be willing to stick their neck out and be liable on the mortgage, and you probably don't want that as well. So our question about leverage is going to have to be something like this. You're going to have to call banks that service that area of Florida, and you're going to have to say, hello, this is Bill. I represent a group of investors from Canada, and we want to buy a $5 million building down there. We're wondering, what sort of loan to value are you willing to consider with no personal guarantees, strictly the lien on the property? Now, I asked that question of a banker that I know here in Canada before, and without batting an eye, he said 50%. So as long as they know the building is worth $5 million, let's assume that a bank that operates in Florida is going to be willing to lend 2.5 on that. So we have our funding requirement, and we're going to say right now the bank has told us that they're going to do 2.5. Bank. Awesome. We're halfway there. Okay. Now, where's the other $2.5 million going to come from? This is going to have to come from investors. It's going to have to be equity. So how are we going to structure this? And I've got a couple of ideas about this. Different people are going to be in different situations. You're investors, and they might have different tax rates, tax brackets, etc., different earnings from other sources, what have you. So most of the time when people are pooling investors for a strictly defined investment, and this happens a lot in the world of equipment leasing, where they'll use a limited partnership. So a limited partnership, the features of that is that one partner has unlimited liability, and then the limited partners, they're protected just like being shareholders in a corporation. They're limited, their liability is limited to the money that they put in. So let's call this Bill Limited Partnership, Bill LP. Let's assume that you're here where I am in New Brunswick. So it's going to be a New Brunswick Limited Partnership. Okay, so Bill's limited partnership, we have to have a general partner. Now, Bill, I know that you probably say it should be me, it should be me. No, it shouldn't. The general partner, the one who faces liability, don't forget, it can be any legal person. So what we want to use is a corporation. So you're going to create a management company or an investment management company, and we're going to call that Bilco Inc. So Bilco Inc. is going to be our general partner. And that then leaves room for the limited partners. Now, the limited partners are going to be the ones supplying the money. And having them be limited partners is great because here's the features it provides to them. Number one, if they put in 10 grand and you royally mess things up and the bank wants to sue you down in Florida and tax people are after you or whatever, they can't be pursued. They were limited to the money they put in. So they have that liability shield, number one. And number two, in a partnership, earnings flow through. So partnerships don't actually pay any tax. Every individual partner in the partnership has to declare their own tax form for their percentage of the partnership. So if somebody owned 10% of this whole partnership thing and there was $100,000 of cash flow one year, they would actually declare $10,000 of that cash flow on their own tax return. So what's nice about this is that if there are people like retired folks who have very low incomes, they might personally want to be the limited partners because they have a lower income tax bracket themselves. Whereas your big wheel multimillionaire investor types, they're going to have like family trusts or corporations or whatever set up to do their investing in for tax advantages, and they're going to make those entities be the limited partner for their interest. So basically, what you're saying is, give me your money. Here's what I think I'm going to do for cash flow for you. You get to manage your tax consequences to your best advantage with your own advisors in the best way that you can. So that makes it simple. So now, what you typically have is a partnership agreement which outlines the details of how the limited partners are going to interact with the general partner, Bilco Inc. So your agreement is going to say that Bilco Inc. is going to manage the property, and these people over here are going to supply the capital. And you might want to determine an equity split here. So you, Bill, are taking the time to put this whole thing together. You're dealing with the bank. You're probably running all over the countryside talking to investors. So you should get something out of this, right? So maybe you decide that you're going to own 20% of the building and that's going to be your fee for putting all this stuff together. So you could say that the general partner owns 20% of the equity and the limited partners own 80%. So they have to cough up $2.5 million. So what you could say, that's $2.5 million bucks. That's a lot of money. So what we can say is that if we take off 3 zeros, you could say there's 2,500 units of $1,000, or you could say there's 250 units of $10,000. It's whatever you think that you're going to be able to raise from each investor. So the second part of so this is kind of like how I would structure this whole plan. And then you would have to, so first you have to identify the property probably. You're going to want to have already identified some of these investors so that when you put the property under contract, you can then give yourself like 90 or 120 days, whatever the seller will agree to as a period before closing, to run around and actually get the money from these people and put it all into the partnership. And then you could execute the transaction, right? So there's a lot of moving parts that have to be done here. But convincing these people to hand over the money, what you're going to have to do there is you're going to have to create some sort of prospectus or forecast that's going to illustrate what you think the building is going to do, how it's going to cash flow, etc. Now, the thing about these limited partnerships is that a limited partnership interest is considered personal property, which means that a person who owns one of these units can give it to their heirs, they can sell it, they can, what have you, just like you would a couch, basically, a piece of personal property. But some people are going to say, how do I get my money back? Because if you tell them, you're never going to get your money back, it's going to cash flow forever and you're going to give it to your kids, some people may not like that. So what most of the limited partnerships in the world of equipment leasing do, or in the private mortgage community do, is that they actually have a horizon for the investment. So what they say is, we're going to amortize the bank loan over 20 years, let's say. You put up your $10,000 or your $1,000 today, and in 20 years, when that loan is finally paid off, the building will go up for sale and we will sell it and divide out the money according to the equity. 20% goes to Bilco and the rest is divided up amongst the limited partners based on their ownership percentage, just like the profit every year from this thing is divided up amongst the partners. So that way, if you go to someone who's 30 years old, for example, they're going to know that when they're 50, if everything works well, then this whole thing will come back. They'll get a whole pile of money back out of this deal. So that's something else to consider. Anyway, great question. And I got to tell you, in this list, there's a bunch more just like it. So stay tuned, everyone. And I had a lot of fun making this video, and we'll talk to you soon.